Hello everyone. Before we open the charts for tomorrow, I want you to address the specific environment we are navigating right now. We are currently moving through January to March window, often one of the most psychologically taxing period in the financial calendar. This is the session where we see heightened structural volatility, not necessarily because of the economic data, but because of the machinery of the market itself. As we approach to fiscal year end, invested companies and mutual funds are aggressively booking profits. They are maneuvering to solidify the figures on their annual balance sheets, figures that will guide and command the narrative for investors in the coming year. While institutions are managing their balance sheets, individual participants are left trying to manage their emotions in the market that is whipping back and forth. And for many of you, this volatility has a cost 91%. According to the comprehensive study released by SEBI, 91% of the individual participants in Indian equity market segments incurred net losses in the fiscal year 2025. We are not discussing minor portfolio fluctuations here. We are analyzing a collective capital erosion for over 1.05 lakh crores, a figure that has widened by more than 40% compared to the previous year. If you are currently managing a position that is deep in red because of the volatile quarter, or if you have recently experienced a significant drawdown, it is vital that you understand the biological reality of your situation. You are not merely stressed, you're experiencing a psychological event. Neuroscientific research indicates that the human brain processes financial loss using the exact same neural pathways it uses to process physical pain. When you look at the mark to market loss, the activity in your brain mirrors the reaction to the physical injury. So, if you're a part of that 91%, the anxiety you feel is not a character flaw, it's a biological signal. The difference between the participants who capitulate and the few who survive isn't just about the technical analysis, it's about the psychological regulation. Welcome to the Nifty 50 post-market analysis. I'm Ajay Eka, and today we are setting aside the candlesticks to focus on most volatile instrument in the market, that is you yourself. We are going to conduct psychological examination of why loss manifests as physical pain, how to identify the symptoms of market burnout, and the therapeutic protocols ranging from stoicism to strict capital management that serves as a mental stop loss. The neuroscience of financial pain. Let us begin with the diagnosis of the sensation itself. In my observation of market participants, a significant loss is often described viscerally, a knot in the stomach or a heaviness in the chest. It is important to validate these are not metaphors. A landmark study published in the Journal of Neuroscience revealed that the striatum, a part of the brain associated with the reward system and the defense mechanism, processes financial loss similarly to how it processes physical pain. When we are in pain, our cognitive functions shift from rational prefrontal cortex to the reactive emotion centers. This acute stress, if left unchecked, has measurable health consequences. Research analyzing millions of the records has shown that stock market crashes and portfolio declines correlate directly to immediate spike in antidepressant prescriptions. In hospital visits for mental health issues, researchers have termed this as recession depression. If you have felt physically ill or mentally fogged after a volatile session, understand that this is your brain hijacking your logic to protect you from pain. However, in the derivatives market, reacting to this pain is by revenge trading or increasing exposure to recover loss in the maladaptive response. It's equivalent to touching a hot stove again to see if it has cooled down. The chronic condition, burnout, and the uncertainty pandemic. If the acute stress continues without intervention, it evolves into a chronic condition, burnout. Operating in the Indian market, particularly with indices like Bank Nifty, requires processing a high volume of information under time pressure. When we look at the period of crisis, such as the initial COVID 19 wave, we saw a India VIX spiked from 15 to over 80. Economists have described such periods not just as health crisis but also as an uncertainty pandemic. Chronic exposure to this uncertainty leads to symptoms that many of you may recognize but ignore. The first one is the chronic fatigue, exhaustion that sleep does not resolve. Number second, detachment, a loss of interest or motivation in your analysis. The third one is the cognitive decline, an increase in unforced error as an impulsive decisions. This state is dangerous because it leads to a breakdown in decision making. You might find yourself obsessively checking global indices late at night, disrupting your sleep cycle, which further degrades your cognitive ability in the next morning. In severe cases, the intersection of financial loss and mental exhaustion can lead to catastrophic outcome. Studies have shown a concerning association between severe financial difficulty, particularly debt and suicidality. Feeling of being trapped by a position or a debt obligation is a critical warning sign. I say this to emphasize the gravity of our profession. Your capital is replaceable, your mental well being is not. If you recognize these symptoms, the sleeplessness, the constant anxiety, the feeling of hopelessness, view them as you would a technical breakdown on the chart. It's a signal to exit the environment and seek stability. Therapeutic protocols, mindfulness, and stoicism. So the next question is, how do we treat these conditions? We cannot control the market gap ups or gap downs. Therefore, we must regulate the internal environment. We need to install psychological safeguards. The first protocol that you need to maintain is mindfulness and regulation. You may view yoga or mindfulness as unrelated to finance, but the data suggests otherwise. Mindfulness practice helps regulate the stratum activity we discussed earlier. It attenuates the brain's tendency to catastrophize negative information. It creates a mental pause between seeing the loss and reacting to it. However, I must offer a professional nuance here. Recent studies on trained mindfulness in financial markets suggest that while it reduces panic, it sometimes slows down your reaction times to low uncertainty. High information scenarios, because of the participants become less reactive to the bad news. Therefore, we use mindfulness to prevent emotional spiraling, not to induce complacency. The goal is clarity, not indifference. You must use the tool to remain calm, but ensure your stop loss execution remains automated and sharp. The protocol number two, the Stoic framework. We can also draw upon Stoic philosophy, which has been studied as a mechanism for resilience in financial grief. The core teaching is the dichotomy of control. As a market participant, you control your entry, the risk exposure, and your exit. You do not control the RBI policies, the global cues, or the algorithmic flows. Research shows that participants who focus on what they can control bounce back faster from financial grief. When a loss occurs, a stoic market participants do not ask, "Why is the market doing this to me?" They ask, "What does this reveals about my risk management?" This cognitive reframing builds resilience. The protocol 3, structural hedging. Finally, to combat burnout, we must prescribe structural boundaries. The 90-minute rule. Research suggests taking breaks every 90 minutes to reset cognitive focus and prevent decision fatigue. Fixed operational hours. Do not carry the market home. Set the hard stop time to prevent the obsession that leads to burnout. Financial risk management and mental health care. We have discussed the mind, now we must discuss the mechanics. In psychology, environment dictates behavior. In the similar manner, in the markets, your risk management is your environment. The first one, the protective stop loss. We established that the brain processes loss like physical pain. A system based stop loss is your pain management system. It removes the need for you to make a traumatic decision in the heart of the moment. It prevents the sunk cost fallacy from taking over your logic. The second one, limited exposure and cash positioning. The SEBI reports also highlighted that the losses are widening, often due to excessive leverage. From the mental health perspective, high leverage is high anxiety. Let me give you a clinical example of why holding overnight exposure is so dangerous for your mental stability. Look at the recent crash in silver. This massive downturn occurred specifically when the Indian markets and the Asian commodities markets were closed. Participants who were holding overnight positions woke up to a catastrophe that they could not physically exit because the markets were shut. They were trapped. But here is the critical part, the diagnosis. The warning sign was days earlier. Brokers had started increasing margins significantly. When the broker raised margins, it's the market's immune system reacting to the perceived risk. It's a sign of an impending volatility. If you have ignored the signal and held exposure, you are gambling on a gap, not investing. I encourage you to view cash also as a position. Holding cash gives you immunity from these overnight disasters. It reduces noise and lowers cortisol levels, allowing you to wait for high probability setups without the desperation to force a trade. The third one, hedging as an insurance. Never operate without protection. If you are long on an FT, holding a put position is not just a financial insurance, it's a psychological insurance. The premium you pay is the cost of your peace of mind. It ensures that the black swan event does not become a life altering crisis. The fourth one is the diversification. Finally, do not let your entire financial identity rest on the derivative segment. Diversification protects you from a catastrophic all or nothing thinking that leads to severe distress. If the equity markets are volatile, but your fixed income or gold allocations are stable, your brain retains a sense of safety. So, as we conclude today's session, I want to leave you with this perspective. Participating in equity markets is often glamorized as a sprint to wealth, but the data shows us it's a marathon for survival. If you have realized a loss recently, I want you to practice self compassion. You are navigating one of the most complex and volatile environment in the world. The 91% statistics proves that you're not facing this challenge alone. Your objective for tomorrow is not just to recover capital, it's to protect your mental capital. Breathe through the volatility, respect your stop losses as an act of self care, and remember that market will open again tomorrow. Ensure that you're healthy enough to meet it. I'm Ajay Eka and I'm signing off for Nifty 50 post market analysis. If this session helped you to find some clarity in the noise, I invite you to follow and subscribe. We will navigate these waters together with discipline and resilience. Prioritize your peace, and the results will follow. Bye bye and take care.